Many still see life insurance as just for the death benefit, but nowadays life insurance has evolved. Today, I'll share with you how anyone can utilize a life insurance policy as a savings tool and how you do not need to die in order to benefit from a life insurance policy. Let's check out this story of two hardworking parents who had two 20-year-old twin boys, Tom and Kevin. The couple had a nail salon business that did very well, so they had a very comfortable life. After 30 years, they sold their shop because they did not have the health or energy to continue business. During those 30 years, they saved about $50,000, but the problem is it was all in cash and this was all they had saved. But the way they saved was wrong. After seeing how hard their parents worked all their life, the boys asked, "Why don't you go on a vacation or enjoy your retirement, Mom and Dad?" They simply replied, "If we go and enjoy ourselves with this money we have left, how are we going to live when it's all gone? Who's going to take care of us? You boys are just starting college. You don't have money to take care of us right now. Our mistake was we didn't save enough, and we don't want you boys to do the same. So let me advise you. Start thinking about saving so you won't have to struggle when you get to our age. I don't want you to have this same conversation with your kids." The boys took the advice of their parents and started saving $20 a day right away. However, the way each son saved his money was totally different and impacted their future drastically. Let's see what happens. Tom decided to save his money in an indexed universal life policy. Kevin, on the other hand, saved his money in a safety deposit box. Here are 4 different scenarios that explain how the way they both saved their money impacted their future. Scenario number 1. One of the biggest problems with savings is how easily accessible is that money. For example, 5 years later, Tom and Kevin have both finished college and now working. Their friends want them to go on a vacation, but they both don't really have vacation money lying around. But this is what happens in most cases. For Tom, he would simply reply, "Sorry, all my money is saved up in an insurance policy, so I can't go." Kevin, on the other hand, would say the same thing, but his friends would say, "I thought you've been saving money in that safety deposit box of yours for the last 5 years. I'm pretty sure you have some money in there. Why don't you borrow some money for it and just return it later?" After Kevin's friends persuade him, he'll do just that and off to vacation he goes. The problem here is both of them are saving. However, the way that Kevin is saving, the money is too easy to access and draw from anytime. Scenario number 2, the growth on your money. For example, 20 years later, Tom, who has been saving $20 a day, $600 a month, and $7,200 a year, would have approximately $206,000 in his life insurance policy. Kevin's also saving $20 a day, $600 a month, and $7,200 a year. In 10 years, Kevin would have $72,000, and in 20 years, $144,000. But being in the safety deposit box, his $144,000 will remain only $144,000. Now, let's say they both decide to stop saving after 20 years, and they leave that money alone for 25 years until retirement. Tom's money at 65 would have grown from $144,000 all the way to $907,000. But Kevin would still have only $144,000 at 65. The problem here is the money Kevin saved has no gain or interest. Scenario number 3, retirement. Say at age 65, both Tom and Kevin want to retire with $77,000 a year. Tom would be able to retire with an income of $77,000 every year for the rest of his life. Whereas if Kevin wanted to do the same and retire with $77,000 a year, his money would only give him 2 years of retirement before it runs out. Then he may have to work again or depend on his kids to take care of him. You see, a retirement income is usually produced by the interest growth on the money you saved up. But the problem here is Kevin did not save his money in a place that allows him to gain interest. Scenario number 4, benefits. Let's say something happens to either of them during these 45 years. Either it's a stroke, heart attack, paralysis, cancer, or even death, Tom's family would receive $1.27 million to take care of themselves if he dies, and this coverage starts from day one of his savings. Kevin, on the other hand, if anything were to happen to him, his family would receive whatever he has saved, which is $144,000 or less. Kevin's method of saving does not give him a living or death benefit. Now, as you can see here, there's a big difference in the outcome of the methods of Tom's and Kevin's savings. Tom can retire comfortably without depending on his kids, whereas Kevin may have to work again or not be able to survive, and this happens to a lot of people. Now, you've got to ask yourself this: do you want this to happen to you also? Plan ahead and plan smart. In less than 10 minutes, we can show you how much retirement money you can potentially receive. All you have to do is message us with your name, age, and how much you'd like to save, and the free quote will be waiting for you.